Hey everyone, well, happy Friday. Welcome to August 29, 2025. That's today. And I'm Phil Hodgen, and welcome to the International Tax Lunch. We do this almost every month on the last Friday of the month, skipping for holidays or if we collide with tax filing deadlines. 9 a.m. Pacific time, noon Eastern, 5 p.m. in the UK. 6 p.m. for those of you in Central European time. Howdy, everyone. You can listen online as you are right now for freebies, care of CalCPA, or you can give CalCPA a little bit of money and they'll give you a CPE cookie at the end of the show. Or we post it on YouTube later. The channel is Hodgen Law 1700, Hodgen Law 1700. You can find all the stuff. This month, is another 5471 thing. I did 11 hours of Form 5471 a little while back, and I didn't cover earnings and profits in that session, so we're rectifying that today. And so, with no further ado, let's pull out my best James Earl Jones voice and say, "This is PTEP, previously taxed earnings and profits." So what we're going to talk about today is to start from the beginning. What earnings and profits, what does that mean just in a general sense? And then we're going to move on to what does it mean to say that we have previously taxed earnings and profits. And you can see I'm going to use initials and acronyms and all of that fun stuff just because otherwise I'd be tongue-tied the whole time. Um, then we're going to talk into once you got this giant vat of PTAP, previously taxed earnings and profits, how do you slice and dice that in a way that goes into the schedules on Form 5471? And then finally, I'm going to walk you through a simple example just to show everything because it's easier to show things than to tell things. Now, like just when you're a kid, mom said, use your words. Well, when we, meaning me, and other people I've noticed, talk about earnings and profits and stuff like that, we tend to use euphemisms like pools and buckets and words like that. I wanted to give you a little slide to be precise about the different concepts that we're using today and what the code and the regulations says when they define these different concepts. So think of this as kind of like eighth grade algebra, and you're solving for the variable x. And if you're using the word bucket and pool, and you've got a formula, an equation with x, y, and z, three different variables, how are you going to know the difference between X, Y, and Z if you're using sort of indiscriminate naming conventions? So here are the conventions that we're going to be using for the most part today. First thing is foreign tax credit. We call those, I do it too, so it's not like I'm holier than thou. Yeah, we call them pools, but in the code you'll see they're called categories. So foreign tax credit categories. Now, once you get on to previously taxed earnings and profits, you have to slice and dice what you've calculated as earnings and profits, and then you've determined as previously taxed earnings and profits. You have to slice that and dice that in two levels. First, into what the code calls a PTEP account, and they do use the initials. And so what you do is you slice and dice your earnings and profits by foreign tax credit category. Then once you have that slice and dice, you can see it's kind of branching out already. You take each of those PTEP accounts and you further slice and dice it into 10 little subcategories if you want. And see there, I've already gone off the rails with the nomenclature. But they call those little 10 sub things PTEP groups. And those PTEP groups are enumerated in the regulations, and I give you the site there. And you can see where those PTEP groups show up on the schedules. PTEP accounts, each individual account that applies to a CFC when you're doing a 5471 will get its own Schedule J. So, you'll see this in a bit. If you've got the general category, the foreign tax credit category, there will be a Schedule J and it has GEN in the top right-hand corner on little item A for what kind it is. And if you've got passive, there's going to be another Schedule J and it's going to have PAS on item one. So that's how you tell the difference between accounts. And then on each of the individual Schedule J's, you'll see it in just a couple of slides, this massive spreadsheet looking thing that if they only had pages that were about 1 billion miles wide, they could put all the columns on that, but they don't. So it spills over to three separate pages. And then finally, the earnings and profits, that bottom row, section 959 C1, C2, C3 earnings and profits. That's the best you're going to do in terms of calling them this. And there are different categories, whatever you want to call it, of these earnings and profits under section 959, because that dictates the sequence in which distributions out of earnings and profits are returned to the shareholder in a taxable or tax-free manner. And it would shock you to find out that when you're making a distribution out of a CFC to a shareholder, it comes out of bucket number one first, and then bucket number two first, and second, and then bucket number three third. And there again, I've used bucket as sort of as a colloquialism or a euphemism, but the correct phraseology is 959 C1 or ENP, C2 ENP, blah, blah, blah. So anyway, do the best you can just on the theory that, you know, using clear language improves your thinking. So if you want to think good, talk good. All right, so let's start with earnings and profits. What is it generally? This is just classic subchapter C stuff. So earnings and profits, big picture, is just this idea that you want to calculate a number that says if the corporation wanted to distribute something to its shareholders, cash, let's just call it, how much money does it have available to do that without eating into capital? So you have a corporation that earns $1,000 of profits in the current year. It pays tax of 150. It has $850 left over in the bank account at the end of the year. Earnings and profits is a tax accounting proxy. You just keep a ledger for it that says, okay, if the corporation distributes anything $850 or below, it's coming out of earnings and profits, stuff that the corporation generated from its activities. If we distribute more than $850 from this corporation to the shareholder, it's starting to eat into capital. And there are going to be different tax consequences of that distribution depending on whether the distribution is treated as coming out of earnings and profits or it's a return of capital. And you can see this in section 301C 123. It says when a distribution is made, first it's treated as if it comes out of earnings and profits, therefore it's a dividend. Second, after you've used up all the earnings and profits, it's a return of capital, therefore you're chewing up basis until basis is gone. And then everything else distributed to the shareholder out of the corporation above that is capital gain. So that's how it works. And that's why earnings and profits is important because it's going to dictate how the shareholder gets taxed. We use GAAP to do all of this fun stuff, and you can see the citation to the reg that says use U.S. tax accounting principles, well, accounting principles generally, to calculate the foreign corporation's earnings and profits so that there's no magic. There's some, go look at reg section 1.964-1, and you'll see the adjustments, and you do everything in the functional currency of the corporation. So basically, if you know how to do earnings and profits for a domestic C corporation, you're in the game here with the CFC too. It's no biggie. Just a page of regs, just so you have it. So this gives the general rule for how it works. Nothing I haven't already said. Now, you do all of that work for the specific accounting period that you are in, this tax year 2024, if you're preparing a 2024 return, 2025 if you're doing 2025, and you show the IRS your work on Schedule H attached to Form 5471. And you can see there, you start line one, start with book income, line two, you do a bunch of adjustments to subtotals, blah, 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 and you come out with current earnings and profits. And so the important thing that we just did there is we start off with the concept of earnings and profits generally, and we just introduced a time element to this, which is, does it coming out of the current year's earnings, or is it coming out of accumulated earnings and profits? And the basic idea is you look at the timing of the distribution, and if there's enough earnings and profits from the current year, it's coming out of there. And if it's more than that, then it's coming out of accumulated earnings and profits. Tax treatment is going to be the same. It's just a question of being able to track everything the way that you need to, and accumulated earnings and profits are tracked, and you show the IRS your work on Schedule J. And here's where things get messy for CFCs, because even before we dive into the concept of how you get previously taxed earnings and profits, just think of it this way. If you just had to track earnings and profits generally as you do for a domestic C corporation, no biggie. But now you've got two categories of earnings and profits, one that has been taxed in some way because of subpart F and the inclusion rules that hit US shareholders, and some that hasn't been taxed. And so you need to be able to track earnings and profits that come from either untaxed earnings and profits, and they're taxed to the shareholder in a certain way, or the distribution from the CFC comes out of previously taxed earnings and profits, and that's going to get taxed in a completely different way. And then there's subcategories below that are because there are going to be some nuances on most often foreign tax credit. So that's why we're going to see these 10 PTEP groups. So this is Schedule J, and you can see on the left, I've got the three columns that are highlighted in green. Those are the columns that you're going to be tracking untaxed earnings and profits of the controlled foreign corporation. There's a lot less of this than there used to be ever since we were blessed with Internal Revenue Code Section 951 Cap A. And incidentally, I'm really, really happy that they decided to change the acronym or the name of that type of income from global intangible low taxed income, which was a mouthful in itself. And it was an insane self-propagandizing move by the government to have you say guilty, guilty, guilty in your head about yourself and your clients all the time. So I'm glad they've changed that, and starting in 2026, it's going to be called net CFC tested income, which is a lot more neutral, thank God. But I'm not bitter about that and the way that they did this for several years. Anyway, so that you'll see column B and column C. This is for acronym, just because they changed the laws over time. So pre-1986 accumulated earnings and profits and blah, 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 treated in different ways and when it's going to be treated. But for the most part, in my real world, column A is where it's at. Post 2017 current earnings and profits drop there. And there's page 2 of Schedule J, and you can see all of the other columns of previously taxed earnings and profits. And off to the right on the bottom, there's a subtotal I just didn't highlight because why should I? Um, anyway, so that's what's going to happen. You're going to be doing a bunch of stuff in your work papers to compute E&P. You're going to be taking that and breaking it out by inclusion. Was it in the income included in the shareholder's income by section 951, subpart F income, or 951 cap A, net CFC tested income? Then you're going to be breaking that out by foreign tax credit category. And then you're going to be breaking that out by PTEP groups and a bunch of stuff. And when you do that, you'll see there are a whole bunch of things that are logically inconsistent. Like you will have a PTEP account for earnings that are included because of Section 951, subpart F income, but you'll have a PTEP group underneath it where theoretically could exist because there's an inclusion under 951 Cap A. And of course, that's illogical. So it's not an infinite number of branches. Practicality is going to make it a lot smaller. But anyway, so that's where it is. And I'm giving you all of this because earnings and profits, frankly, and foreign tax credits, for me at least, are just a shit show in terms of Form 5471, and they give me the biggest brain damage of all. And it took me a long time to start to understand earnings and profits generally, and then previously taxed earnings and profits specifically, and then mechanically how it works. And if you are kind of in a confusion and you're just sort of doing things mechanically here when you're working with CFC PTEP, I would encourage you just to really dive deep and learn the fundamental principles because this is what I'm going to try and talk to you today about. So you can separate the bullshit from the jelly beans. Because if you're just doing things mechanically or you're looking in instructions and you're saying, oh, I've got a square peg, I better put it in a square hole. Well, you're going to get somewhere, but you're not going to have the mental acuity to say, yeah, that doesn't really look like a square peg to me, and maybe I shouldn't put in the square hole after all. Maybe it looks like an octagon, and I should put in the octagonal shaped hole. And the tool for this, I mean, this is my personal experience, is that if you sit down and you just bang on AI for a while and you say, you make it your plan. I'm going to start at the front end. What is E&P? And you just ask it dumb questions until you understand what it's telling you. Then you can move on to the next thing. And then you can ask the same question again and again and say, I don't get it. Because AIs don't answer you very clearly, typically. They're just a mouthful of gravel. A lot of times, sometimes it's great. But it has infinite patience and you can come at it from a different way and you can give it an example and you can learn the fundamental principles of how it works because there's so much detail here that you really get lost. Now, I want to also tell you about AI, and all of you, I'm sure, are using AI to a greater or lesser degree. There are better and worse tools. Um, so I run three side by side. I use Accordance, so accordance.com, which is a stealth AI specifically written for tax. It's not on the market yet, but it is an order of magnitude better than everything else I use. Really good. Um, and I use ChatGPT and I use Claude and I have paid accounts for all. Um, you can ask this identical question to three open windows and get three different answers, or you'll get two answers that come to the same conclusion, but for different reasons. So don't trust everything it tells you, but I mean, that's just par for the course for AI. But what I'm going to tell you specifically is do not rely on the general purpose AIs, ChatGPT, Claude, your favorite. Um, get a specific tool. And I like Accordance. And for what it's worth, after this ends, I'm going to ping out an email. Um, the people there at Accordance have a code that you can get a 2-week free trial, even though they're not on the market yet. So you can test it out for yourself. I think you'll see a massive difference in quality for the types of answers you get compared to just ChatGPT. Anyway, that's just me. All right, so having gone on a little bit of a side rant about earnings and profits generally, let's get into previously taxed earnings and profits. So what is this and why is this? So the problem in the bad old days, and the bad old days is defined as before 1962, is that if you were a wealthy US citizen, you'd you would game subchapter C, right? Subchapter C says that a shareholder doesn't have any income out of a corporation until the corporation makes a distribution. right? So you put some capital into a corporation and you never pay a dividend. All of that capital is going to compound inside the C corporation until it comes out, and then you, the shareholder, get taxed. Well, if you add subchapter C to the basic concept of America is strong, but it doesn't have strong enough guns to make every country on the planet a U.S. taxpayer and every corporation in every country a U.S. taxpayer, you see a foreign corporation that doesn't have U.S. source income and it doesn't do any business in the United States is out of bounds for the U.S. tax system. So you put $1 million into a foreign corporation in Bermuda and you invest it in the stock market in Europe or anywhere outside the United States, and it earns dividends and capital gain, that those investment returns are not going to be taxed until 25 years later, the corporation in Bermuda makes a dividend payment to the US shareholder. So what you've done is you've played the time value of money game and you've basically created a roll your own IRA. And to say the IRS and Congress doesn't like that is an understatement. So that's why we have subpart F. It's the controlling of the timing of income. In subpart F, section 951 just says, no, the U.S. shareholder is going to get taxed on the earnings and profit, the income, subpart F income technically, of the CFC in the year it's earned instead of in the year of distribution. All right, so this creates second order effects, right? So if in 2025 that Bermuda corporation has $500,000 of dividend income, and the U.S. shareholder is taxed on $500,000 of dividend income. And then in 2030, the Bermuda corporation distributes $500,000 to the shareholder. Well, that's a distribution out of earnings and profits. And Section 301(c)(1) says, hey, presto, you got a dividend and you, the U.S. shareholder, have dividend income. So double taxation. First time on the make pretend inclusion of income, where 951 says, let's make pretend that you were taxed, that you actually earned those earnings and profits in the year that CFT did. And second, on the for reals distribution and the dividend. So to their credit, Congress sees that and says, all right, we're going to solve this. And they solved it with Section 959 that says, if a CFC makes a distribution out of previously taxed earnings and profits, meaning the income was included in the U.S. shareholders' income, gross income, because of Section 951 and later 951 Cap A, then that's previously taxed. And when you distribute that money to the U.S. shareholder, you're not going to pay tax again. It's excluded from gross income. So that $500,000 distribution does not even hit the Form 1040 of that U.S. shareholder. It's excluded from gross income. Earnings and profits calculations, you're going to make adjustments on Schedule J for the fact that 500,000 was distributed out at the CFC level, but you're not going to have income at the shareholder level a second time. So in a nutshell, that's what it is. It's like for every action, there is an opposite and equal reaction. And you can see this in the One Big Beautiful Bill Act that we just passed. Remember we had a problem with, in 2017, they eliminated a piece of Section 958B4 that magically allowed downward attribution, magically created a bunch of CFCs that didn't exist before, and magically created a bunch of U.S. shareholders of CFCs that didn't exist before, just because of the downward attribution rules. Well, they fixed that in this year, 2025, with adding back the downward attribution ban. So now we don't have it anymore. But then they had to add on Section 951 Cap B, which is just an interesting thing. You can look at every code section. You can see either this is a core code section that does something, or this is a code section that was installed because either the the taxpayers gamed the system and the government didn't like it, or the government realized they made a boo-boo and they had to fix it. And so 951 Cap B is just, oh, we made a boo-boo the first time around. And so this is just like more sediment dropping to the bottom of the lake in the Internal Revenue Code. I kind of look at the Internal Revenue Code as, what was that? The Anyway, in Hong Kong, there was an old city that was just sort of jerry built, and everybody lived in it, Kowloon, and now it's gone. Hidden City or Lost City of Kowloon, whatever. Anyway, I digress. So distributions from PTEP are not included in gross income. This is section 959. And you have to do a whole bunch of tracking, which is what we're going to be talking about. And then we'll see the distributions coming out of the different categories that are specified in section 951, 959. Now, you can see the different 959C categories here on Schedule J. So the green ones are category 3, the untaxed earnings and profits. And then you see starting in column E and going E1 through 10, little Romanet 1 through Romanet 10, these are categories 2 and 3. And no, 1 and 2, pardon me. So you just look at it, you can see this is an example of where you're going to find the matchy-matchy between what happens in the code and the regulations and the tax forms. And I've got to say that one of the stellar things that the IRS does is design tax forms that make relatively simple whatever is happening in the code and regulations. So if you're ever confused about what the code and the regulations say, you go find the right form and you find where the code and the regulation resolves down to on that form, and you can kind of work backwards with some plain numbers and say, oh, that's what they meant. And so here in my example here, I'm showing you how Schedule J resolves back to specific code sections, why they're there. And those columns that you have listed and they're highlighted, those come from Reg Section 1.960-3C2. So this little thing, there's a lot of meta information in the forms. All right. Anyway, when does current E&P become PTEP? So this is accounting periods problems. How do you actually close an accounting period and move something from being classified as current E&P and move it into reclassified into previously taxed earnings and profits? The answer is everything happens at the end of the year, and it's got to happen in a specific sequence. So the first thing is let's just start with E&P generally. So E&P is calculated, the current E&P, as of the end of the year. Duh, because if it's still September, you don't know what the income of the company is going to be for the year yet. So you don't have a current E&P number. All right. Subpart F income. So you look at the income of that CFC and you decide whether it is subpart F income, either subpart F income under 951 or net CFC tested income under section 951 cap A, which is taxed the same way as 951 income. And you can see that in 951 cap A little f. And so you calculate E&P at the end of the year and you calculate subpart F income at the end of the year. Well, you can't calculate subpart F income until you've calculated current year E&P because there's an upper limit on the inclusion, which is the maximum amount of inclusion is current year E&P. So that comes second. So this is what's going to happen. First, you're going to calculate E&P, then you're going to calculate subpart F inclusion, and then you're going to see in a little bit the amount of the inclusion is PTEP. And so the last step in your game is going to be, well, I now know what the inclusion is. It's $100. Now, how am I going to allocate that out into the various different PTEP accounts and then into the PTEP groups? So why is it so complicated? And here's a single slide thing, and we've got 14 columns of data. Column D is hovering deficits, which is just one of those things which is such an obvious hack to fix a logical gap in the system that they've created here. So this is, this is wheels within wheels, and the Copernican revolution. And, the ancient astronomers couldn't explain retrograde movement of the planets, and so they made up these funny little things. And so this is the tax rule, the equivalent of retrograde movement of the planets. Anyway, Schedule D, we're going to ignore completely. But otherwise, all of that is here. And why? Here's the rule that says you have to divide all of your previously taxed earnings and profits into annual PTEP accounts. And you can see here the rule is you have inclusions under section 951, little a in parentheses, so that's subpart F income. And they're still using the old acronym, but net tested income under 951 cap A. And then each of those is further divided into 904 categories, which are the foreign tax credit categories. And there are four in section 904D, and there's this, anyway, there are a bunch of them. And then once you have each account, and these are theoretical, and this is all in your work papers, this doesn't show up yet on Schedule J. Well, and elsewhere, it's going to show up for foreign tax credit limitations and stuff like that. Once you have everything in each account, you're going to divide it down again into a PTEP group. And here is where, for instance, the easiest one to understand is why do you have to do all of this stuff and divide it? For instance, at the PTEP account level, well, an inclusion of income under 951, subpart F income, and an inclusion of net CFC tested income is going to have different indirect foreign tax credit treatment because you get 100% possibility of credit for subpart F income, but you only get 90% of the actual foreign income tax paid for 951 cap A income. So that's 960 little a in parentheses subpart F, 960 little d in parentheses for 951 cap A income. So this is just a simple example of why they want you to divide it all into these tiny, tiny little into PTEP groups, so that when it comes time to take that PTEP and use it elsewhere for other reasons, they can get the right results they want, in this case, for the purpose of the indirect foreign tax credit under Section 960. So with all of that, because that's just noise, and you need to go through it, you need to be comfortable until you can just sort of yap about really high level hand wavy stuff so you just understand how it goes. Let's go into a very simple example, and you can see how the numbers are going to flow through all the way from a simple example of a simple company to the different schedules. So we go to CFC, and it's a U.S. shareholder, owns 100% of it, a human, and the CFC is in the Cayman Corp Islands, and it does three things. Well, first, it sells things, and I'm just choosing it because it's a simple example. It buys inventory from a related party manufacturer in Hong Kong, um, and it will sell stuff directly to customers in Canada. So just ship straight from Hong Kong to Canada. Kids these days call that drop shipping. Nobody, Canadian income tax, not been doing business in Canada. Second, it sells stuff to people in Germany, and there it's got a branch office, so it's doing business in Germany, and German local tax law says you got to pay German local income tax, corporate level. So it pays income tax, the CFC does, at the corporate level because it's got a branch in Germany and pays 25%. And I'm choosing 25% because it makes it high tax exception income. And then the final thing is it has money in the bank in Cayman Islands and it earns interest on those bank deposits. So pretty simple situation. First, let's look at how this income is characterized for CFC taxation and US shareholder taxation. So the Canadian sales, when a CFC buys inventory from a related party and sells it to unrelated people. In other words, the CFC is just a paperwork markup machine, going through. That's called foreign-based company sales income. Foreign-based company sales income is one of the categories of foreign-based company income. Foreign-based company income is one of the categories of subpart F income, and subpart F income is included in the U.S. shareholders' gross income for the year. So that's the mechanism by which whatever income is generated by the CFC from its drop shipment sales into Canada will eventually show up on the U.S. Citizens Form 1040 as part of gross income. The German sales, again, we have purchase of inventory from a related party manufacturer, sale to the general public. So it's that functionality that creates it as foreign-based company sales income. There's also foreign-based company services income, where instead of sales, with one leg of the transaction, a related party as a buyer of a thing, on services, one leg of the transaction is a related party with respect to services, either the buyer or the seller. So anyway, again, we go through the same exercise. Foreign-based company sales income is foreign-based company income is subpart F income is gross income to the U.S. citizen shareholder. Finally, this category of foreign personal holding company income for the interest. Foreign personal holding company is classic passive income, unless you're actively engaged in being a bank or something like that, which we're not. Foreign personal holding company income is foreign-based company income is subpart F income. Done. So all of these items are going to be includable in the gross income of the U.S. citizen under Section 951, little a in parentheses, 1 in parentheses, capital A in parentheses, subpart F income. Now, that's your financial statement. You just got it in words. Here's what the Form 5471 flow from schedule to schedule is going to look like. And I'll show you actually screenshots of the schedules in a sec. But these are summaries. You're going to start, of course, off this slide with your work papers, which you're going to drop all the income and expense on your work papers onto Schedule C, which is the income statement for the CFC, and you do some calculations. As noted before, whatever your book income is, it drops into Schedule H to calculate earnings and profits, current year earnings and profits. So you drop book income in there, and you can see the matchy-matchy for the green boxes. The green box above goes into the green box below. You do a bunch of munging to it and adjustments to adjust current earnings to current income into current earnings and profits. And you come out with two numbers. And this is the beginning of allocating it into PTEP accounts. You see on the left, we have a Schedule J, and on the right, we have a Schedule J. So we have, by virtue of all the hard work you did in your work papers, we know that some of that earnings and profits will be passive, and therefore on the right is going to go, the little pink boxes will go to the Schedule J for accumulated earnings and profits for $400, and that goes on Schedule J there. And on the left, Schedule J for general income, which is what the operating income is going to be for this CFC, the $1,600 that we show for what happened there. And again, the 1,600 and the 400, the two Schedule J's, there's a total Schedule J where you combine all of the entries on all of the Schedule J's you attach, and you give the totals, and you see there's a pretty good matchy-matchy system so the IRS can cross-check a number on one line against another. You can see this, the total current earnings and profits The total one is going to be 2,000 across that bottom line, and that 2,000 matches up on Schedule C to the current earnings and profits, and it matches up to whatever happened on Schedule H. So, but that's the flow of what's going to happen and how the numbers are going to bounce from one form to another. So let's start with a bigger picture of what it looks like. So I start off with the assumption that the Schedule C, they made $1,000 in Canada and $800 in Germany. They remember the $1,000 in Germany, in Canada, there is no Canadian income tax. Germany, there's going to be a 25% tax. And you can just look at the numbers as they flow down. I assume no dividends. You end up with $2,200 pre-tax, $200 tax at 25% on the German income. And so net profit after tax is going to be $2,000. Schedule 8, let's take our 2,000 net profit after tax, because remember, that's the number where, in theory, if the CFC wanted to distribute some money to the shareholder, that $2,000 is what it's got. And so now we're going to prove that by calculating that we have $2,000 of earnings and profits right here. So we start with line one, which is the book income, 2,000. I heroically assume we don't have any adjustments on line two. And we come out to on line 5A and then 5C that we have $2,000 of current earnings and profits for this CFC for the year. So that tells us that if there was going to be a distribution this year, we would know that the first $2,000 of that would be from current earnings and profits. And then you can see down below at 5C, little Romanet I and little Romanet 2I's, the Schedule H asks you to break out the current earnings and profits by foreign tax category, foreign tax credit category. General and passive is what they want. So we have general category income of 1,016, so 1,600, because that's 600 left over after Germany paid the tax, and 400 of untaxed interest income from the Cayman Islands. Just to be clear on what are passive and what are general category income, these are the foreign tax credit categories. And you'll need to know this is a passive is passive category income. Here you see how your algebra teacher is very careful to label the variables X, Y, and Z. So we have variable, which is passive category income, X. And passive category income consists of passive income and passive specified passive category income. So X equals Y plus Z. Passive income, and we're not using this in the generic term, we're using this as a definitional phrase out of the Internal Revenue Code. Passive income means foreign personal holding income. So there's yet another variable, A, as defined in 954C. And there's some modifications. But for our purposes, um, passive income equals foreign personal holding company income. Interest is foreign personal holding income. So if you follow that trail all the way up, interest is foreign personal holding income, personal holding company income is passive income. Passive income is passive category income. And hey presto, you have the foreign tax credit category 904D1C pass. Specified passive category income is for foreign sales corporations and discs, and those in my world are largely passé, so I ignore them cheerfully. So for my purposes, passive category income 99% of the time is going to mean foreign personal holding company income. General category income is a residual category. You take all of the income, you subtract three other categories of income. income described in paragraph 1A, which is section 951 Cap A income, foreign branch income, which is not applicable to a CFC because foreign branch income only applies to US shareholders with foreign branches, and passive category income. And so in this example, we're not playing the 951 Cap A game because we want to keep it simple. We have start with $2,000 of PTEP. We subtract the passive category income, 400. So whatever is left over, the 600, 1,600 is going to be general income. And that goes on the general category, Schedule J, or specifically to the PTEP account for general. All right, now that we've got from on Schedule J, we know where to take a number from Schedule H. Now we have to put it on Schedule J. Well, how do we do that? So we haven't, remember, we haven't done any inclusion yet. So we haven't even come to, is it PTEP or not? We just have done this. So we're moving it, getting ready, staging it to become PTEP. So what you're going to do at this point, since you saw on 5C, Romanet 1 and Romanet 2, general and passive, now we're going to create Schedule J's, one for each of those, and we're going to port some numbers over. And we're also going to create a total Schedule J at the end that's going to pull all the numbers together for easy summary for the IRS. And the starting point for this is always going to be you're going to take it off of Schedule H and you're going to put it in column A and specifically on line 3. So that's where you're going to start this whole game. And you see in the top right-hand corner, the highlighted thing that's the little code for general or passive in my example. And so that tells you which PTEP account you're working with. And now we're going to move the numbers on into the PTEP account here for the IRS purposes. And we've done that by adding it in line 3. Now what? Next step is we're going to show you the same thing that happened on the passive Schedule J. So now that we've taken all of our current income, we've put it onto Schedule J, now we're ready for the next stage, which is to show the effect of the income inclusion that causes these two numbers to become PTEP. So we're going to convert them from untaxed current earnings and profits to PTEP. So as long as a number sits in column A, ignore column B and column C because that's just, if you've got a really antique CFC, you're going to see something in there, but otherwise you're just going to see a carryover from prior year on line 1 and that's it. So ignore those. We're just going to look at column A. There's nothing to show when it's in column A that there's been an inclusion or not. And so the way that you tell the IRS that there has been an income inclusion at the shareholder level is by doing subtract from column A, add to the correct column in E1 through 10. So this is specifically how a number gets allocated out of a PTEP account in column A into a PTEP group, which is E1 through 10. And once the number shows up in column E1 through 10, now you know that earnings and profits amount is previously taxed earnings and profits. And again, the sequence. Step 1, remember we compute earnings and profits at the end of the tax year. The inclusions under 951 or 951 Cap A also happen at the end of the tax year, but it has to happen after the current earnings and profits are known because that E&P limitation that I've cited there in section 952 C1 Cap A. So you have to know earnings and profits before you compute inclusions. And then step 3 is whatever your inclusion is, that is your PTEP amount. And now your only job is to put it over in the right column to show what type of inclusion it was and what PTEP group it goes into. So here's what we're going to do. In both of these cases, The income inclusion is going to be under Section 951, is subpart F income. Remember, it's foreign-based company sales income, which blah, 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 becomes subpart F income under Section 951A1A. Um, so you put a negative number on line 8 of minus 1600, and you put plus 1600 in Schedule J, and that is your data entry that shows the IRS that you've moved it to the PTEP group that's correct. And you can see there are a whole bunch of different categories. There's stuff that you're tracking for Section 965 purposes, and that's historical at this point. There's stuff that you're going to be tracking for Section 245 Cap A purposes. That's the dividend received excluded deduction, which is not part of this example, but we could do another example and show you how it works. Um, what else? There's anyway a bunch of different stuff in there that really doesn't matter to us. The two that you're going to see most in your life is column 10, little x in parentheses, which is subpart F income, and column 8, which is net CFC tested income. So for my life, Vilfredo Pareto is my God, and 80%, 80% of everything is going to go into those two. And again, passive goes to column EX, so again, it's subpart F income. But what you see here is kind of cool because now, to the extent there's foreign tax credit coming in the future, you've got a category for passive type income for the foreign tax credit limitation, and you've got the general, and you'll be able to pull the PTEP out of there to see what your limitation is going to be for Section 904. So that's the flow of the numbers from all the way from money comes in the bank at the front end of the CFC until you've done the year-end Schedule J, where you've accounted for the E&P. And notice that the money here in the column E and the subcolumns is still current earnings and profits. It's not accumulated yet because it's not the next year yet. So it's still there, and will, to the extent there's a distribution, now we're going to allocate it amongst distribution, the categories. And distribution, frankly, is going to be a whole nother 1 hour show for this ever-ending, unending 5471 series that I'm going to be doing until I finally get it right. So I'm not going to go deep into that. Um, Untaxed earnings and profits, what do you do? Here's where they sit. Remember, we did a subtraction, um, and whatever is left over at the end is going to be whatever is current earnings and profits. And this, if you look at the top in the column heading, it says 959C3, untaxed earnings and profits. And that's what you have here. And we have a little residual number of 600 here. And why are we doing that? Because it's high tax exception income, and I'll show you that in a little bit too. Anyway, we take these two numbers, we make it total, and that's just monkey work for us and something for the IRS just to cross-check numbers with. Um, Earnings and profits at the shareholder level. You see that this is Schedule P, and this is a kind of way for matchy-matchy for the IRS to track what's happening, make sure that what the CFC reports is what the U.S. shareholder reports. And for our purposes here, for the most part, P and J are going to track. They'll be different, obviously, if you have a shareholder that doesn't have 100% shareholding. There are some technical reasons why the inclusions might be different and PTEP might be different. But those are going to be oddball situations. And for the most part, I'm going to treat this, and especially for our example, because we don't have a lot of time left, just it's going to be matchy-matchy. And the numbers are going to come over from the Schedule J into the Schedule P at the right column. So we're going to have the same $600 of untaxed earnings and profits, and we're going to have the same $1,400 of previously taxed earnings and profits. Um, the difference for Schedule P is that Schedule P, in addition to having everything in functional currency, has the same values but in US dollars. So think of it this way. When PTEP is included in the gross income of the shareholder in a particular year, there's a currency exchange, a conversion from functional currency into dollars at that year. So think of it like you've got basis now at this point. Yeah, PTEP is your basis and is frozen in time at that. What happened? And then the problem is for the IRS, and this part solves it, is what happens if you have PTEP in one calendar year at a specific currency exchange rate between the functional currency and the dollar. And then a few years later, the distribution actually happens and the exchange rate is shifted. How do you track that? How does the IRS track that to be specifically? And so this Schedule P, this part, is designed to do exactly that. So it's going to do a calculation of PTEP in US dollars when the PTEP was included in gross income and do a running total of that. And when the distribution is made, that'll show up on Schedule P. And again, at the current exchange rate, and you're going to see there may be a difference. It might be the same, it might be higher or lower. And you will have some currency gain or loss based on that. So let me give you, just to wrap it up, a little quickie example of how this works. So let's just assume the CFC functional currency is the euro. And in year one, it has 100 euros of subpart F income inclusion that it passes through to the US shareholder. So the US shareholder has $100 of subpart F income. Boom. Schedule J is going to show 100 euros of PTEP. Schedule P is going to show 100 euros of PTEP and $100 of PTEP. Year two, this is the year of the distribution, where the CFC distributes 100 euros to the US shareholder. Now the exchange rate is slightly different. 1 euro buys a dollar and a nickel in US monies. So Schedule J on the CFC side is going to be fine because it's in functional currency. It had PTEP of 100 euros, distribution of 100 euros, remaining PTEP is zero. Bingo. Schedule P at the top part on the shareholder side says shareholder had PTEP of 100 euros, received 100 euros, in functional currency has remaining PTEP of zero. But in this last part, Schedule P expressed in dollars is going to say, had PTEP $100, received $105, used up PTEP of 100, what's this 5 left over? How do I report that? And the answer is, it's ordinary income under Section 986, the currency rules. So that's how it works. And if you flip these, you could have a loss the same way. So this is how the IRS is going to track and be sure they get their money and they tax any currency fluctuations when distributions happen in a different year than the income inclusion from a CFC. So let's wrap it up because we're almost done. So what can I tell you? E&P is tedious. Uh, as you're doing this, again, I commend you just have an AI window open and say, oh, AI, don't understand. Why is this? No, I still don't understand. Explain it different. Um, it will help. You'll have to spend a lot of time staring at the code and the regulations, and of course, they're not always written clearly, but you do your best. The hard work really truly is going to be in your work papers when you're taking raw accounting data and you're breaking it down into income inclusion, 951 and 951 Cap A, the different PTEP accounts, and then the PTEP groups. And there are so many fiddly rules that apply. And then once you've got your PTEP and you're starting to step out and apply those PTEP groups to foreign tax credit or to distributions, becomes even worse. So I really encourage you. I used to think that AI is going to solve all my problems, but that was like new me straight out of law school in the early 80s. And I saw this citation that said 1982-1 CB 327. And so I went into the office of the guy next door to me, Don Chow. He's dead now. And I said, Don, what's this CB? And he carefully took me to the law firm's library and he pointed to this wall of gray books, cumulative bulletin. And I looked at that wall of books and I looked at, the wall of the regulations and the code and all of that. And I said, wow, the answer to every tax question must be here. I just have to find it and copy it. Little did I know. Same thing here. AI is not going to answer your questions. You're going to have to get really good and know first principles of taxation, and it's going to reward those who do that. So I encourage you, study harder than you've ever studied. That's all I can tell you. Again, I'm going to send out that 2-week free trial code to Accordance in a few minutes after the show is up. And there we are, all done. If you want to send me emails with questions, comments, suggestions, whatever, um, please do. There's my email address. Sign up for the newsletter if you're not on it already. You'll hear new and upcoming stuff. Specifically, save the date in New York, September 16, 2025, 2 p.m. to 5 p.m. Eastern Time, live at the New York State Society of CPA offices at 200 Madison Avenue. We're doing an afternoon of tax stuff, so get on the newsletter and you'll get information about how to show up and have fun with us. And of course, there'll be free party afterwards. Um, I'm paying. There we are. Happy times. See you next month. Next month is going to be on September 26, 2025, and the topic will be Form 3520, when to file, what to report. See ya. Back to you, Elaine.